Thank you for joining us. If you have any questions, you can just type in. And if you have any comments which you think maybe will be helpful for others, you can also type in the comment section. Today, I've got, we have our guest, Lovemore Nyatsine. Lovemore Nyatsine is the CEO of, Lovemore Nyatsine is a multi-award winning business executive. He's a CEO with a leading digital solutions provider in the transportation and logistics space. He has worked across Africa with vast experience in business, philanthropy, entrepreneurship, and telecom sectors. He holds an MBA and studying towards a PhD. He's passionate about leadership, strategy, and transformation. He's a life and executive coach and a management consultant. He's the author of 2 books, Seeds of Greatness and Rise Like an Eagle. Lovemore Nyatsine says that ultimately life is not what you're called, but what you answer to. He says, I use my hands, heart, and voice to help others discover and live their purpose. And we also have Themba. We have what's the Themba before? Themba is a chartered accountant with more than 24 years of experience in corporate financial management and risk management. He holds a master's in business administration and has been a consultant and trainer in areas of risk management, asset and liability management, and investment management. And he's an upcoming author of the book, Manage Your Personal Finances Like a Black Belt. So welcome on our platform, Lovemore. I'm just going to go for it. Lovemore, why should people invest? Today we're talking about investments, so I'll just ask Lovemore, why should people invest?
Thank you very much, Tafadzwa, and thanks, Themba, and thanks everybody for having me on this platform. It's really such a pleasure to be on this platform and to have a conversation around the issue of investment, something that is very important, not just for the current generation, but even for the next generation, but importantly, for us Africans to have, an interest in understanding why it's important for us to invest, because you need to understand that for every dollar today that we have in a country like Africa, every dollar that we earn, you actually find that less than 10% of that is invested. Whereas when you compare with countries like India, you find that the investment, the savings culture there is much better, is much higher. And for every dollar that they are actually earning, almost 50% plus is actually being invested. And no wonder why you see those countries growing. But to answer your question more directly, Tafi, you find that we invest because the way life is that there are years where we will be earning, or we are working and earning. And when we are working and earning, we need to set aside something for that day when we will be not working, but we need to survive. And that's why it's important for every single one of us to understand that there are years when we are active, we are running up and about, we are earning, the income is coming, but there will be years when we will not be active, when we will not be working, we will not be earning. And that's when we need to have something on the side to be earning for us, so that, as they say, the proverbial rainy day, when we then go into those investments to begin to work for us. So your investment works for you when you can't earn. That's number one. Number two, we should also invest in order for us to work towards a big purchase. It could be a car, it could be a house, it could be buying a business, it could be whatever, sending kids to college. You need to have put something on the side so that, for that day when you want to make a big purchase, there is something on the side. So you're investing basically for 2 reasons, like I said. Number one, to make sure that when you're not working, you can still earn. Number two, for big purchases. There are many other reasons that people choose to invest. It could be to invest for your children so that, you leave an inheritance for, or some other such reason. Please confirm, Tafi, that you could hear me.
Yes, I could hear you. Thank you very much for that insightful information. And I'm just want to check with Themba. What holds people back from investing? Lovemore has mentioned that we invest for rainy days, and also maybe for us to purchase big purchases. But why people may be hesitant to invest?
Thanks, Tafadzwa. Thanks, Lovemore, for those opening comments that you gave there. I must just confess to you, Lovemore, I follow what you put on Facebook, actually. I don't know if you have seen that. And I know for sure that you are an accomplished investor and you are passionate about the subject. What I've heard from you is that investing helps even as far as economic growth in a country is concerned. It's in our interest to really invest, particularly for the future. Tafi has just asked me, why do people not invest? Obviously, there are so many reasons, and I haven't done a study about this, but I will tell you some of the reasons that I have heard from people that I've had close interaction with, and also from people that I have had the opportunity to mentor and also to teach on this subject of investments. I think, firstly, it's lack of knowledge. In the Bible, there is a scripture that says, my people perish because of lack of knowledge. What I've seen is that, when it comes to investments, there's ignorance, like, sometimes one would never imagine, especially among people who have not taken the time to educate themselves. So firstly, it's lack of knowledge. Some people confuse investments with speculation. And so you will hear stories like, I tried to invest in shares and then everything went wrong. I will never invest again. And so people have got horror stories, and it boils down to lack of knowledge. And part of what we're trying to do on this platform is to disseminate knowledge so that people can be really comfortable with investment. In addition to that, I think it's also lack of discipline. We've been saying on this platform, Tafi, and we've been encouraging people to separate at least 10% of their income and designate that amount for investment. That takes quite a lot of discipline to do. One of the things that you will hear from people, especially given the economic situation that we are in, is that, hey, I've used my money for everything else. I no longer have money for investment. So it really takes quite some discipline in budgeting, in separating an amount of money. I don't know if Lovemore agrees with us, but we are of the view that separating money for your future is something that you must do as a matter of necessity, as well. I also tell people that with a certain level of education, you can actually take the future into your hands. Because what tends to happen sometimes is that we outsource investment, and that's a good thing, by the way, where we don't have the knowledge, outsource it to somebody who is much more knowledgeable than yourselves. But we go further by saying, this is something that can be learned, and we can develop knowledge to such an extent that we can become, knowledgeable investors, there. The other reason why people don't, invest, I think it's got to do with, let's just call it lack of mentorship. You need people to show you the ropes of the trade, so to speak. You need people to guide you, like everything else. So I will stop there. I think those are the three basic reasons, why people, don't invest. I believe that investment is something that everyone, should be doing, but you need, discipline. There has to be a commitment of energy, commitment of time, and even a commitment of money. I think it's a point that we highlighted in our session, yesterday, Tefi. I've got a laundry list of other reasons, Tefi, but let me just stop them.
Thank you very much, Themba, for those points that people need discipline and people don't invest for lack of knowledge. And based on that point that people are hesitant to invest because of lack of knowledge, Lovemore, what should people invest in?
Thanks, Safi. There are a number of areas in which people can invest in. The first thing that one can invest in that is very easy, that is easily reachable or accessible for most people is investing in the stock market, is investing in the money market, is investing in unit trusts. All these investment categories or classes of investments are easily accessible. And I'm really, really targeting the retail investor, you and me, the individual, even a go-go, even, an old man, a young man, all these investment classes that I mentioned are easily accessible, without much hassle, and you don't have to put aside a big amount for you to invest. So that's number one. I'm really talking of marketable securities, money market investments. And obviously this is dependent upon which market you're operating in, because in Africa, there are certain markets where it might not be advisable to put your money in a money market. But I want to focus, for purposes of this conversation, a little bit more on investing in shares. Shares give you an opportunity to own a company, a share in a company. It could be Insco, Simbisa, Econet, Rio Tinto, you name it, any company that you wish to invest in. So shares are a good investment destination. That's number one. Number two, it's also good to invest in property. The beauty about investing in property, it's an investment category that is risk. The risk there is much lower if your appetite for risk is lower as compared to shares, which can be volatile. Investing in property is a fairly low risk type of investment, that one can invest. So those are the two main areas where one could actually invest easily. And for purposes of a conversation today, would want to just focus on those.
Thank you very much, Lovemore, for that. Last week, Themba, you mentioned that you spoke something about risk appetite, and Lovemore just mentioned about risk appetite, that investing in property is a low risk. Though I would have wanted maybe Lovemore to also expound, because if one doesn't have cash, as much as property is a low risk, how does one go around it? Because maybe shares, to invest in shares, as much as it's risky, you can start anyway, you can invest 100 rands. But with property, probably you need some 100,000 for you to start. How does one go about it?
Right. There are a number of platforms that one can use in any country today where there's a stock exchange. So if you're in Johannesburg, for example, you can look at different stockbrokers that are accredited, that are validated by the Johannesburg Stock Exchange. Most banks actually have a stockbroking arm. Nedbank, for example, has got a stockbroking arm. FNB, you can also get, stockbrokers from FNB, Investec. So many of the banks today, financial institutions in South Africa today, actually are also stockbrokers. So there are many of them. If you're in Zimbabwe, you can actually also go to the number of stockbrokers that are accredited or validated by the Zimbabwe Stock Exchange. You open an account And once you open an account, you give money to your stockbroker, you can have a conversation about the kind of shares you would like to buy, but also importantly, your investment philosophy, your investment objectives, so that the stockbroker can invest in line with your investment objectives. If you are a short-term person, you can then look at stocks that are going to do well in the short term. If you are long-term, you can also look at stocks that have got a long-term, ability to earn. So those are some of the things that you can do. Then secondly, you can also use, digital platforms that you can use for you to invest. There is easyequities.co.za, which is one of the best apps that I've used to date. It's very easy to open an account with easyequities.co.za. Once you do that, you're able to actually buy shares on your own on the Johannesburg Stock Exchange, Australian Stock Exchange, New York Stock Exchange. You can also buy shares even on some of the European exchanges, the Johannesburg Exchange, I've already mentioned that. So that's a brilliant, platform that you can use to buy shares. That's number one. Number two, you can also, in Zimbabwe, use ZSC Direct, zscdirect.co.zw, where you can also buy shares, or you can also use ctrade.co.zw, again, a digital platform where you can buy shares. So there are many, touch points that make it easy for people to buy shares in today's world. Even in other countries, I'm sure there are also apps that one can use to easily buy shares if you are a retail investor. Very risky-free, very friendly. Some of them you can also have phantom trading or fantasy trading, where you learn how to trade without actually spending money until you get the hang of it. So, Taffy, there are many platforms that one can use to invest.
Thank you very much, Lovemore. Themba, on the issue of shares, I just wanted also to just ask, before you touch on how can someone know their risk appetite. Lovemore spoke about investing in property and shares. I understand that one can also maybe invest in property, but through shares. Would you want to expand on that? I think there are also maybe stock valves where one can do it. You're investing in property, but not buying the physical property, but doing it through shares.
Thanks, Tafadzwa, for that question. So yes, one can invest, in property through the stock market as well, and even through the money market, through unit trust. So if you've got a particular passion for property, on the JSE and on most stock exchanges, they are, companies that specialize in, in property. So they manage, commercial property. Some of the companies actually manage, student accommodation, that kind of property. So if that is your passion, you can invest in those particular, companies. On the JSE, apart from companies themselves, there are quite a number of property funds, themselves that are listed, as well. One can also go for a property unit trust, if so they are all these vehicles. The reason why one might want to do that and not own a property is that, if you do not want to go through the headache of managing a tenant, then that's probably, something that you might want to, to consider. And then going on, Tafadzwa, to the other question that you asked me, how does one determine their investment appetite? I think the starting point is to mention that investments are subject to risk. When we talk about risk, we are basically, in simple terms, talking about the possibility of loss of, either capital or even the profit that you have accumulated on the investments. So that's what a risk is. There is always the possibility of losing, capital, or losing even the gains that you have, realized on the investment. So it's very important that one understands their risk appetite. So when we talk about risk appetite, we're basically talking about our ability to assume risk in the investments that we are managing. And let's also understand that some instruments are riskier than others. For example, an instrument such as investing in government stocks or investing in gilt securities, those are some of the safest investments. So if you look at how instruments are structured, any investment into an instrument issued by the government is in finance considered to be a very, very risk-free instrument. And then above that, we've got other instruments such as fixed deposits. Those are low risk, instruments, as well. On the other side, on the extreme side of the spectrum, you've got risky instruments. Shares are also risky. You also have cryptocurrencies. They are also risky. Derivatives, they are also risky. So that would be sort of the spectrum of how risky instruments are. How does one determine their risk appetite? I think there are many factors that go into it. The first factor that I would want to single out is your financial goals. So for example, at some stage, I had a financial goal to retire in 5 years. So if you've got such a financial goal, it means that you have to assume more risk, because in finance, it's also accepted that the higher the risk that you are assuming, the higher the return. So if your financial goal is such that you want to retire, soon, then you would have to take more risk. You would have to be a risk taker. You would have to have that, capacity for risk. But if you want to retire in 100 years, then probably there is not much risk that you would need to take. So that's a factor that goes into determining how much appetite you must, assume. The second thing that is also used by financial planner is your age. So it's well, accepted that younger people probably have got, more capacity to assume risk than older people. So for example, if you have retired, you are old, you are living on a pension, you are living on your investments, then there is no risk at that, there is no need at that point to take more risk. You tend to invest in less risky instruments, such as the ones that I have mentioned, fixed deposits. In most of your investments will be on the money market, actually. So age has to be a consideration. The other thing that has to be a consideration is experience and knowledge. So the more experience you have, the more you can take risk because you're becoming more comfortable. The more knowledge you have, the more risk you can actually, take on the markets. So that also, determines. Another factor that determines your risk appetite is your financial situation. So there are people who've got more investable, funds than others. So if you've got surpluses, you can actually take more risk than somebody who does not have significant investment, capital. So the amount of, investable funds that you have, the more risk that you would then, tend to take. But it's very important to understand your risk appetite so that you don't invest in things that are beyond your risk appetite. And as you gain more knowledge, as you gain more experience, you can actually aim for higher returns and invest in instruments that that give you, higher returns. Interestingly, Tafadzwa, I was talking to somebody in Cape Town yesterday about investments, and I was in Stellenbosch, and in Stellenbosch, there are rich people there. Some of them own wine farms and what have you. And this person just said to me, he was talking about the Oppenheimers, showing me some of the wine farms that they have and some of the horses that they have on the wine farm. And that person actually made a comment to me that actually says, do you realize that this money that they are managing is money that was made in generations, that have gone by. So probably the person who is now running the Oppenheimer Family Trust could be a fifth generation, kind of person. In other words, they are managing money that has been made by their ancestors, so to speak. And this person just made a comment that says, because these people have made money over generations, they can actually take, a position that will yield, results for them in 100 years. So the more money you have, the more generational wealth that you have, the more you can actually take risky things that people are not even thinking of doing. Because what this person was actually showing me is that the Oppenheimers have made a decision to actually go throughout Africa and investing in all the farms that are near rivers and near dams, because that's where they see, investment, returns in the next 100 years. And what that just says to us, Tafadzwa, is that, the more money you have, investable funds you have, the more risk you have, and the greater the capacity to take such risk that, even people without investment capital cannot make. And this person made a comment that I will never forget. And the comment went something to the effect that, generational wealth is smart money. And what they were basically saying is that the Oppenheimers would never go broke because they've got this capacity of seeing in 100 years. So most of this generational wealth that we are talking about was actually made selling diamonds. But the current people that are actually managing that generational wealth are no longer selling diamonds. They've almost disinvested from diamonds, and they've gone, in farming and in other things, because that's where they can see investment potential in the next, 100 years. And that's the beauty about investing. You can create investment wealth and generational wealth that you can pass on to your descendants. And because your descendants have grown in environments where they were taught to invest, they will be able now to understand how investments work and to take positions that may yield fruit in 100 years. Something that probably other, communities do not have the capacity, of doing. So I just found that, interesting. So those would be the factors, Tafadzwa, that one can use to determine their risk appetite. To me, it boils down to knowledge. The more knowledge you have, the more experience you have, the greater your capacity to take risks. The more investable funds you have, the greater your capacity as well to take more risk and to get more returns on your portfolio.
Thank you very much, Themba. Lovemore, Themba spoke a lot about opportunities, like finding opportunities. If one would want to invest like in property in Zimbabwe, maybe they're in diaspora and they want to invest in Zimbabwe, what would you say are the advantages and the disadvantages of investing in property?
Thanks, Tafi, for that important question. Right, property. I think I did like what Themba mentioned earlier on, because you can invest in property-linked assets that are not necessarily property itself. You have companies in South Africa like Redefined Properties. I've invested in them before. Where sometimes you're actually not investing in the property itself, but in underlying property. So there is that opportunity. But let's talk a little bit more about investing in property. My own investment philosophy and what I've learned is that with property, you don't have to go for the big properties, 7-bedroomed house, 8-bedroomed house, 4-5-bedroomed houses. Those are not the properties that have the best returns when it comes to investing in property. So my philosophy is to invest in small, medium-sized properties. The reasoning is very simple. There is a burgeoning group of or growing population or demographic of people who are young, who are upcoming, who can't afford a house of their own, and they are probably first timers when it comes to working, and they're looking for property to live off, young families. Those are the kind of properties that give you the best returns in terms of investing in property, because it's not just about having a property to your name and the title deed and saying I own a 5-6 bedroom property. The key about owning property is rental income, because property actually costs a lot. Sure, in South Africa, you agree with me that there are levies that we have to worry about, security levies, you got to pay, to the body corporate, all those amounts of money. And obviously, the bigger the property, the better the complex you're living in, the higher those costs are. So you got to really, really go for the low-end properties that offer the best returns. Some of the places which are excellent for you to invest in properties are places where there are schools. Stellenbosch is one. In Cape Town, for example, Johannesburg CBD is one. The Braamfontein area, all those areas are excellent for investment properties where you actually have got, students who are likely to look for student accommodation, and you're guaranteed of returns. The other property category is for targeting the Airbnbs, the tourists who comes. For example, Mamungeni precinct in Johannesburg, that whole area is excellent with tourists. The urban renewal that has happened there means that the properties you find in that area are likely to be great with tourists who are coming to visit South Africa and having a feel of South Africa. So those are some of the considerations when it comes to investing in property. And you also need to really think intently about the country you are investing in, apart from obviously the category of property you are investing in. Some countries, the rental income, you got to be very careful when it comes to investing in certain countries, because you don't want to wake up with a volatile currency and here you've got a property that you invested so much, but the return is in a currency that you're not comfortable with. So again, it's really about spreading your risk, but also buying property, even in countries as far as Turkey, Europe, the US even. You'll be surprised how easy it is to be buying properties in places like Dubai, Turkey, Cyprus, South Africa, even, the US. It's very easy to be buying properties in those sort of countries where you are guaranteed of, rental income in a currency that is stable, that also guarantees, return for your investment. So those are some of the considerations that I would say one is to make or to take when they're investing in property.
Thank you very much for that information, very insightful. Themba, investment journey, what mistakes have you made? Or what have you learned from the mistakes?
I've made so many mistakes, Tafadzwa. But let me talk about some of the mistakes that I have made and that I have seen people making, as well. Mistake number one is, starting too late on your investment journey. I would just urge our audience and everyone who will listen to this, presentation, start today, because the more you procrastinate and not start on your financial independence journey, the more difficult it would be to start and to realize, what you would want to realize. So I think that would be mistake number one. Mistake number two would be to take investment tips from your neighbor next door. Because what I have seen is that some people make their investments based on what somebody has said, and they don't do careful research in terms of the investment opportunity. So somebody would say to you, oh, by the way, cryptocurrency is the in thing now, where people are making money, or whatever it could be. And so people are looking for investment tips in terms of what is the next thing that will make me, what will make me rich. So what I've seen is that there are quite a number of people who do not have that discipline to research on any opportunity, to read and educate themselves crunch the numbers as it were. They are waiting for the next hot investment tips. So that's a mistake that people make. Another mistake that I would want to caution people against is just investing without a plan. So we are very, very clear, what should precede your investments is a clearly crafted plan in terms of, these are my financial goals. This is my investment appetite. And therefore, these are the investments that I would need to consider in my, investments journey. So that's how I would actually, do it. The other mistake that many people make is to confuse investments with speculation. So what I have seen is people are trying to predict the next market move. And people have made, have lost quite a lot of money trying to, to do that. In my view, investment is long-term. You must be disciplined about it, and not be all about, I've even seen people who, at some stage in 1 month, they've got a discipline to invest, and then they take that amount, out of their investment portfolio because they've had an emergency here and there, and therefore they do not allow their portfolio to grow over time. So you must have some kind of patience when it's, it's about, about investing. Then we also need to think about managing risks. So as we go about investing, it's very important that we also manage our risks. So what I've seen people sometimes doing is, financing their investment portfolio, using too much debt. And as a result, when interest rates go up, their investment portfolio comes crashing down. So I think we must, set parameters in terms of how much debt you can use to finance your investment, portfolio. But over time, as you make money, it's also advisable to diversify your investment, portfolio. I have seen people put their investment capital in one instrument, in one geography. I cannot tell you, stories of how many people lost, savings and lost money when the economy of Zimbabwe went, hyperinflationary. It's because, their, investments were invested in monetary assets, and monetary assets can easily be eroded in value by inflation. So we need, last week I did mention that one of the great enemies in investing is inflation. So one has to be mindful about the inflation risk, because that can eat into your investment, the value of your investments and what you are trying to do. So as we invest, let us also be mindful that there are enemies. And these enemies are all these things that can erode our investment capital and the gains that we are making on our investment. And inflation is one of them. So at the end of the day, everyone who has done investment will tell you that in essence, the discipline of investment management is, all about managing the risks about investments. So that's one thing that I would want to, to just, bring out, there. Unless you know what you are doing, have limits in terms of the amount of debt that you can use. Try to diversify your investments. Don't invest in things that you do not know, or things that are shrouded in secrecy. Another mistake that I have seen people doing is that they invest in an instrument, but they can't tell where they are going to get the value, from that investment. That's why you have seen people being duped. Let me use the word duped, because that's exactly, what happens. People have been duped out there into investing in pyramid schemes, for example, or schemes which promise high returns over a short period of time. And people have lost money, that way. So when you are starting on your investment journey, my advice is for you to invest in accredited instruments or regulated instruments to begin with, because you're trying to manage, your risks. As you gain more knowledge and as you gain more experience, you can then go for other investments, because you almost join an investment community. You have educated to yourself to an extent that you are part of an investment community, and sometimes you are privy to inside information, so to speak, which the general public do not have. Until you get to that stage, I wouldn't advise anybody to be investing in instruments that promise an astronomical return over a short period of time, because people have lost money in investment schemes. You need to be, you almost need to understand what it is that you are investing in. And before you part with your money, do some kind of due diligence. Is this scheme registered with the regulatory authorities? If we are talking about, schemes that sometimes are shrouded in a lot of, secrecy. Let me just tell you a story. I like telling stories, Tafadzwa. The story that I will tell you is, and this is a very sad story. It's about a father who actually put all his pension, money into a pyramid scheme. And these people would actually give him statements of, the growth in his investments. And he would tell his children that, look, the latest statement is showing me that I've got $1 million in my investment. And this guy actually passed on, 2 years ago. And they asked me to look at the statements and try to help them retrieve the money that the father had left, so that they could finance the funeral and sort of divide the inheritance. When I looked at the statement, I could immediately see that this was a fraud. The guy had been duped, and even up to now, he went to the grave not knowing that he was not leaving an inheritance, for his children. So sometimes you've got these horror stories that actually happen, and we need to be, very careful about all of those things. So those are some of the mistakes that people make, Tafadzwa, which we really need to be, very, very mindful, about. But let me stop there, at least for now.
Thank you very much, Themba. You seem to have mentioned all the mistakes that people make during investment. I was going to ask Lovemore if he has also made a mistake in his investment. If he hasn't, or he doesn't have much to add to what Themba has already mentioned, I've got some questions from from non-Klantla. So if you have something to add, Lovemore, then I can ask the question.
I do have some investment mistakes that I've made. One of the things that I did at some point was to speculate on a particular share. I knew that they were going to pay a dividend, so I got in just to chase a dividend. And then I got the dividend. It was a very good, healthy dividend. But soon after, there was a serious sell-off of that particular share, because, once people earn dividends, they then sell off. And the share, I lost more money, in the share depreciation than what I had earned in the dividend. So I really learned that you don't have to speculate. Have a very clear, scientific, informed position when it comes to why am I investing and how do I invest. So that's one of the things that I have really learned, that you don't have to speculate. Get into a share knowing the fundamentals of that share, the earnings per share, the different ratios that people look at in terms of the capacity of that share to do well even going forward. Also looking at the historical issues about the ability of that particular share to perform in good and bad times. That's why the other mistake that I made, secondly, Taffy, is that I used to think that let me invest in penny stocks. You know, you buy a share for 10 cents, and if it goes to 12, 13, 14 cents, you've made a lot of money. Again, that's a fundamental investment error that I've made in the past. That doesn't work. You know, the idea that, you know, if you buy in a share stock, in a stock because it's lowly priced, then, you know, you have an upturn. That doesn't work. It was a disaster. So those are some of the two mistakes that I've made in terms of, you know, investments.
Thank you very much. That's very helpful information. Nontlanda is asking, are unit trust savings or investments? Because the only time I hear about them is when people from places like Metropolitan Life or Sanlam are selling savings.
I would defer that question to Themba, yes.
Okay, that's fine.
So the way we've distinguished savings and investing on this platform is that, you know, you save for a short-term objective. So savings is something that you are doing for a short-term objective. An investment is something that you are doing with a long-term objective. And one of the things that we have said, you know, on this platform is we are urging people to invest so as to work towards their financial independence, you know, plan. So we've been quite clear what precedes, you know, everything and investment is a plan. So we must be very clear about our goals that we want to achieve. So essentially, Nontlantla, what I'm basically saying is that don't be in a hurry to buy instruments because somebody is selling them if you are not sure how that fits into your investment plan, right? Whatever instrument you're going to buy, whether it's sold by Metropolitan, you know, or it's a unit trust, it has to fit into your plan, right? So a unit trust, you know, savings or investments, right? You can actually buy a unit trust as part of diversifying your portfolio and as part of a long-term objective. In that sense, it becomes an investment. And in my earlier years, I haven't told this story, you know, Tafadzwa. I actually bought my first car cash. And the reason why I was able to buy my first car cash, you know, maybe Lovemore may relate to this story, is actually I invested in Kingdom Unit Trusts. And the interest that they were paying at that time was actually quite high. And when I redeemed my unit trust after a year, I had lots of money to actually pay for my car cash. Not only did I pay for the car, because it was a Japanese imported car, I actually said to the people, I've got enough change. Can you fit new tires, new everything? And that money, I actually made it from unit trust. So unit trust can also be a saving, right? You need to be very clear about the type of unit trust that you have invested in. Some unit trusts are more risky than others. You need to be very clear about the return that you are getting from that unit trust and whether you're actually achieving your objective. So to answer that question, you know, Nontlantla, are unit trust savings or, you know, investments? They can actually be, you know, they can actually be both. I have used unit trust as, you know, savings, and I was able to buy my first car. I've also used unit trust as part of a college fund for my kids. And that I have been able to use them to diversify my portfolio. So that's how I would answer that question. But the important thing to me is not to buy because somebody is selling you something. You need to educate yourself ask relevant questions on what this unit trust is offering. That's what I would say, Tafadzwa.
Thank you very much, Themba. Maybe this one I can ask Lovemore from Northland again. What are the key questions to ask when you want to invest?
Right. The key questions you want to ask when you want to invest, number one is the question, why do you want to invest? Because that question will guide in terms of your investment objective, investment goals, which in turn guides the investment classes or assets that you invest in. So the key question is, why do I want to invest? Am I investing in order for me to prepare for retirement? Am I investing in order for me to have a kitty when my kids are going to college? That's a college fund. Am I investing so that I'm able to save up for a big asset in another 2, 3, 4, 5 years, maybe buying a house, deposit for a car, deposit for a house? So those questions are important questions because then they inform the investment that you buy into. Whether it's a share or whatever you are investing in should be guided by, why am I investing? Once you address the question why, the what, the how, the where, and the when becomes easy. So the most fundamental question to ask is why. And once you address the why, the what, where, who, when, how becomes easy. So I would say, those are the questions that you want to ask first. Number one, why? And then once you ask why, you go to what then, how, when, like that. I hope that addresses the question.
Thank you very much. I'm sure it does. The why, the how, the what, the where. Maybe as you do your research, you know which question comes first. Themba, would you want to give us a closing remark, maybe in a minute or so? Then after you, Lovemore can also just give us a closing remark.
I just want to address also to add on to what Lovemore has said in terms of the key questions to ask about an investment. Lovemore, in South Africa, I've come across many people who have been duped through pyramid schemes. They're quite a number. And I'm just being practical here. If somebody puts me under pressure to buy their investment and I'm being pressurized, and I'm being asked, Taffy will tell you, we've traveled a long journey in investments. Sometimes you'd get a call from people and say, I've got an investment, that I would want you to consider, Themba, come to a presentation. Now I don't do those presentations. I don't do anything where people present. I need time to look at the investment. And I totally agree with what Lovemore has said. Does this investment that I'm about to buy fit into my investment objective and my financial plan? Am I being pressurized, to buy this investment? Do I understand the risks and the costs associated, with this investment? Are these people even registered? It's very, very important, non-Tlantla, especially if you are new to investment and an investment product is being sold to you, for you to just Google and see whether these people are actually registered with the Financial Sector Conduct Authority. They used to be called the Financial Services Board. They are the people that regulate all the investment that goes on. Is the person that is selling me this investment, because in South Africa, you cannot sell investment advice unless you are accredited by that particular authority that I have spoken about, the Financial Sector Conduct Authority. Are they registered? Are they accredited to be dispensing this kind of advice that they are dispensing? Another key question that I would ask, before I invest, because in South Africa, these investments are being sold through intermediaries. And so I always ask the question, what's in it for you? You can determine it even from the person who is trying to sell you this investment product. Because what I have seen is that there are a lot of people out there who sell investment products not because they have got our interests in mind, but because they're trying to sell, a product so that they can benefit themselves. So a key question to ask, particularly when you are buying investments through an intermediary, is what's in it for these people, right? Are their interests aligned with my interests? Because that's something that I have learned, over time. As a parting shot, Tafadzwa, I just want to say to everyone, we can always be, we can all be investors. We start small, and then over time, we grow our investment, portfolio. So it's just an encouragement to all of us. Let's embark on this journey. Let's start today. You start small. One of the things that I have heard from Lovemore today is that we can start with shares. He has advised us to consider an app, easy equities. So that's what I would do as a first step. To me, I like people who take action much more than people who theorize, because most of what you learn in investments, you learn through practice. You don't learn through theory. You actually learn by doing, and then you become good at it. It's like riding a bicycle. You have to ride a bicycle to know how, it feels to be on a bike, and to become an expert, over time. And that's the thing, with investing. Over to you, Tafadzwa.
I would like to hear Lovemore's closing remarks.
Thanks very much once again for having me on this platform, and everyone who is out there. The first thing that I want to say is that it's very important to understand that the principle of investing has nothing to do with the size. It has to do with the principle of investing. Look at your rand today, that 1 rand as a seed. If you put it in the ground, that 1 rand will have babies, which will in turn have babies and have babies and have babies. So I want you to understand that investment is about understanding that what you have in your hand today is a seed, and you use it to give birth to more fruit. If you learn to eat a fruit without studying the seed, you will always be a consumer. And for you to become a producer, you need to start to play this investment game. And there's a lot of information out there, including platforms like this one, by the way, where you can start to learn how to get into this game and understand, how can I also become a producer? How do I play this investment game? Number 3, you need to understand that investment is not speculation. You need to understand that when you are investing, you are playing a long game. And there is fundamental analysis that you can apply to investing so that you don't lose money. But if you listen to speculators, if you also listen to people who promise you the moon and the stars, oh, honey, no bees, trust me, you got to take a step back and stop and say, is this true? Because there are people who promise you, everything in this world, by just investing, and they'll tell you that you'll get so much money. Please don't listen to those kind of people. Investment is a marathon. It's not a sprint. And you got to understand that there is a lot of information out there that can help to guide all your investment decisions so that you don't waste money. And lastly, I want you to understand that every time you're investing, you compound your investment over time. And that investment could easily, give birth to much more. If you look at some of the richest people in the world today, in particular, Warren Buffett, who is the example that everyone always uses, he has always been investing over a long period of time, you'll find that here's a guy who probably bought Apple shares when they were just $1 each. Today, Apple shares are worth much more, thousands and thousands of US dollars. So you got to understand that when you're investing, particularly in shares, today they might be worth $1, but tomorrow, or a rand, but tomorrow they will be worth, much more. So play a long game and start today. And it's never too late to start. And it's never too early to start when it comes to investing. That is if you start today. And I want to encourage you to start today. God bless you and thank you.
Thank you very much for that. Want to thank everyone who joined us. We have Nuntandla, we're saying thank you, Themba and Lovemore. We have Patience, we're saying informative. Thank you, Themba, Lovemore, and Tafadzwa. Thank you very much for joining us, everyone. We really appreciate your support. Thank you, Lovemore. We really appreciate you joining us today. We hope to have you next time when available. For Lovemore is a life coach. If you want to get hold of him, he's on Facebook, and I think his social handle is Lovemore Nyatsine. He's also on LinkedIn as Lovemore Nyatsine. His books are also available on Amazon. So if you would want to get in touch with Lovemore, you can check him on LinkedIn, Facebook, or on Amazon. If you would like to get hold of Themba, you can visit his website, www.duplexinstitute.com, or subscribe and follow his YouTube. Manage your personal finances like a black belt. You can also check out our website, www.tafadzwamazibukospeaks.co.za. Thank you everyone for joining us. Enjoy the rest of the weekend. Cheers.